Hi, Mr. Mortgage at you on the 21st regarding a new report out on home equity lines and loans from Standard & Poor's. You know home equity lines and loans are a favorite topic of mine. As a matter of fact, on my blog and also on YouTube, I did a video a few weeks back called Big Banks' Deadly HELOC Exposure. It talks about all the big banks, Wells and their $84 billion in home equity lines, and Bank of America and Citi and Chase and WAMU, Wachovia, Countrywide. You need to go take a look at it. My new blog is www.mrmortgage.typepad.com, and of course you know how to get to my YouTube channel. Now, before I get into this, I want to announce my new collaboration with the guys over at ML Implode. For a year to a year and a half, that's where I've been going for my mortgage information news, breaking news. Their insights are something, they're invaluable. Can't live without them. Also, I want to thank Carl Denninger, www.denninger.net, for his daily contribution in keeping us all informed. Today, S&P said 9.19 of lines issued in 2005 and 11.45% of loans issued in 2006 are delinquent. That's up about 6.5% apiece. Serious delinquencies, which are 90-day plus, rose almost 9%. That's insane. Now, by itself, I know it's insane, but everyone else might not. So let's put it in context. Let's take some other pieces of data out there and fill in the blanks. Bank of America earnings call this morning was rather bleak. 82% of net charge-offs related to loans where the borrower was delinquent and had little or no equity in the home. There's your negative equity effect. I love that topic too. I've been talking about that a lot. As a matter of fact, the Boston Fed about 90 days ago came out with a research report saying that negative equity is and will be the leading contributor to loan default, even more so than periodic ARM adjustments. Simple. When people are upside down in their home, they do not want to keep paying on a depreciating asset, especially with exotic loans where payments might keep going up. Now, I have to give it to the Fed. They've cut rates more than anyone would have ever imagined in the last 6 months. And home equity lines are tied to prime, most of them, a lot of them. So they have been dropping, but still, negative equity is negative equity. Their payments have just gone down a little bit in paying for that depreciating asset. Now, I want to also tie it in with this Fitch report here. Okay, Fitch, U.S. home equity woes. Banks grapple with higher losses. This can be found on my blog as well. This came out on March 7th when Fitch, actually March 14th, but on March 7th, Fitch took negative ratings actions against 8 of the largest banks in the nation. Talks about their home equity exposure, their growth in 05 to 07, how many loans they have on their books, the percentage of those loans versus their total assets and their total equity. And it's staggering. I mean, Countrywide, Washington Mutual, National City, Wells Fargo, Bank of America, Citigroup, they're all mentioned in here. And it's a pretty scary situation, especially when these lenders and banks have very little recourse. I mean, although they might be recourse loans, what are they going to get from foreclosing? They really can't foreclose because, you know, we're in a bubble state. These loans were mostly done in 05 or 07 in the bubble states. We're down 15 to 40% in those states. Home equity lines on purchases typically are done over 80% to avoid mortgage insurance, MI, right? So instead of putting 5 to 20% down, you get a second mortgage and you can do a 100% loan, or a 95, where you have an 80 first, a 15 second, 5% cash down, or 80-20, zero cash down. You've all heard of that. On refis, most of them are between 75 and 100%. So if we're down 15 to 40%, and most of these loans are done in the bubble states, that means the majority of these homes or loans are likely in a negative equity position, also meaning it's likely to get worse. And it's all outlined here in this Fitch report, and it was a pretty scary report. It didn't get a lot of press. That's why I covered it. Also, you know, these loans are worth 1 to 3 cents on the dollar out there. So I believe there could be some relief coming for consumers. Now, these banks aren't selling them. They're just holding on to them, watching them drop one by one. Why not open them up to the consumer and let you buy that back for 30 cents or 40 cents on the dollar? It gets you right in your home again. You get to pay off your second. The banks get 30, 40 cents on the dollar when they're getting 1 or 3 cents, if they could even sell these loans now. And I think it would be a great first step in getting, you know, a lot of this problem, or some of this problem, solved out there. So go onto my site, and take a look at the documents that are there, and read the post summary of this video here, because this home equity line and loan exposure is something that isn't getting a lot of press, but it will start to get a lot of press. The banks are sitting on billions of these. Again, Wells Fargo, 84 billion. I think they've only taken about a 3 or 4% write down on their portfolio, when most of their loans are in bubble states, and they've even told us that most of them are over 80% combined loan to value. So it doesn't make any sense why they would take such a little write down when it says here the numbers are clearly higher than that. So this could be some problem coming forward with the banks too in their earnings, but that's something for you guys to figure out. I'm just going to tell you how these things are acting, and they're acting like the defaults and the delinquencies are going to get much worse, especially with foreclosures rising. We know that's happening, and values dropping more and more every day in the states where these loans were done the most. If you like this video, please give me stars. I like the stars. They're good. Go on to the comments section and let's talk about this. If you're not part of the solution, you're part of the problem. Also go to my blog, mrmortgage.typepad.com, and get involved with the comments there. It's a lot of fun once you start doing it if you have the time. Anyway, have a great day. We'll be right back at you with something else tomorrow. And don't believe the hype.